Hi guys, welcome back. So I have made my 2021 strategy to be half in rising industry and half in emerging market. I made this strategy in the December last year when everyone was quite fearful about Chinese stocks. But recently we have seen nothing but falling hard for a lot of Chinese companies, and following with the market correction of the tech stocks, the Chinese stocks actually just dropped more. So does that mean I need to revisit this strategy and change my plan from now on? Do I still believe starting from 2021, Chinese stocks can outperform? So in this video, I'm gonna cover first, why did I think so? Second, is it still valid now? And third, why do they just keep falling? And fourth, what to do? So first, why did I think the Chinese stocks would begin to outperform starting from the year of 2021? I have shown in my video in the past, I think Chinese stocks have been beaten down for years already because of the trade war, the COVID happened, and the delisting, the blacklisting, etc. And we have seen the bottom of the ridiculously low valuation already. And I expect to see it rising after it hits the ground. And also, from the macro economy, we see Chinese economy to overtake US by the year of 2028 due to COVID. Published by a UK-based Center for Economics and Business Research, said China's skillful management of COVID-19 would boost its relative growth compared to the US and Europe in coming years. This was published in December last year. And in January, this is published by the CNBC. New chart shows China could overtake US as the world's largest economy earlier than expected. Updated February 2021. And they pointed out China will likely overtake the US as the world's largest economy a few years earlier than anticipated, economists said. This shows you the growth path up to 2020. And if we keep going down, as they see the Chinese currency would strengthen compared to US dollar. And if it can go around 6 yuan per US dollar, China could surpass US 2 years earlier than anticipated, which is in 2026. So I think this trend is undefeatable, and yet the trend had not been priced in by the share price because mostly from politics. I make my plan to go strong in the Chinese stocks and Chinese economy in December, and at that time, most people were still very fearful on Chinese stocks. On November 17, the US is pushing ahead with the threat to delist Chinese companies. At that time, all the Chinese stocks were diving at the same time. Once they took a break with a little bit rest, 2 weeks later, December 3rd, US bill to delist Chinese companies from stock exchange passes in House of Representatives. And then all Chinese stocks went down again. After a little break, again 2 weeks later, on December 18, Trump signs bill that could delist Chinese companies from US stock exchange. Of course, all Chinese stocks went down together again. 1 week after that, on December 24th, Alibaba stock suffers record fall after antitrust probe in China. And because Alibaba is basically the FANG stock for China, so most of the Chinese stocks fall hard again. So of course, all the news resulted in the Chinese stocks share price like this and this. Bad news and political issue one after the other, then of course the Chinese stocks valuation would stay on the floor. So the second reason was because I expect the new president to ease off the relationship between the two countries. And I expect there is only so much that the politics can beat down the share price or valuation. I think it would have reached a limit already, and not much further down the valuation can go. And the third reason was, have you heard of the cycle of stocks? That the stocks would usually begin in fear, and then grow in observation, and then finally end in euphoria. So I really thought there were just too much fear built around Chinese stocks, and people were quite sick of the Chinese stocks drama. So then it might be a good time for the cycle to begin. So on the day Alibaba fell quite hard when everyone was extremely fearful, I bought the dip on this day and I found out later that ARK Invest did the same thing. So from the three aspects I just described, first the macroeconomy support, second the politic issue would not last forever, and third it seemed that the cycle was beginning with the fear. Next, is it still valid now? Recently, I got a lot of questions asking me if I'm still bullish on Chinese companies. Seeing them dropping so hard every day, it's hard to take. A lot of people came to me and said that they have lost quite a lot with Chinese stocks recently. A lot of things have happened since I have made my plan last December, so it might be a good time to revisit. And for this, I want to show you some data and facts that had happened within this few months. I have said this before, that I think the Hang Seng Index can still have room to grow just like the Shanghai Composite. If you look at this chart, we see that we are still below the peak of 2007 and 2018. And the Shanghai Composite looks to be even weaker. It has not even broken through the triangle yet. So it's below the 2007 and even the 2015 and 18th peak has gotten lower and lower every time. And with the China economy rising, I see this still has a lot of room to grow, especially when you compare to the S&P 500, which has been growing all these years. You see the 2007, 2018, in comparison with what we just saw in the Asia market. And recently, the report from the JP Morgan published on March 31st can explain this. Here, they did a summary about how the inflation and the movement of the inflation result in different return on investment. And since the year of 1988, when we look at low and falling inflation, which occur for the recent 30 years, we can see here the emerging market equity were really the lowest, to be 2% compared to the 12% in US. So that would explain why the index had basically been stagnant all these years in the Shanghai index and the Hang Seng index. But as we all have been expecting the inflation to rise, so we can see for the other period, low and rising inflation and high and rising inflation, the emerging market equity actually outperformed all the other ones to be 16 and 26%. And it would be even more for the high and falling inflation, but we don't anticipate to be in this period right now. So for all the other three scenarios, we see emerging market equity to outperform the others significantly. And this is not the only interesting part. It's actually quite an interesting report. The other part I want to show you is this is the cycles of US equity outperformance. So the gray part is the US performance and the purple part is the more out of the US market. So we can see that not only sectors rotate, countries and market rotate too. We can see that the outperformance of US stocks compared to the outside would peak at some point and then rotate back to the other part. So far it has been going on for 13 years. That's why we would never know when it can rotate out of the US. That would explain why Ray Dalio has been saying for a while to diversify into the Asian market. And we can see that Bridgewater bumps Alibaba up to the 6th place in the portfolio. And actually its first position in stock holding, that's not an ETF. And this belief has been confirmed by many institutions as well. Like Charlie Munger just recently built a position of Alibaba in Q1 2021 to be the 3rd largest position. Kathy Wood says she sees potential in disruptive Chinese tech firms, even though their shares had tumbled recently. And they have been increasing their exposure in Chinese market, even though the Chinese stocks have been falling heavily. Several Alibaba Group biggest investors, like Baillie Gifford, have swapped their shares from the US to the Hong Kong stock. It was during the worst time for Chinese stocks in 2020. before the election. So it means even though they were well aware of the potential political risk to keep going on, the investment in China market is just something too big to be missed. So I like to compare Alibaba and Amazon a lot because it really shows how ridiculously some of the Chinese stocks are valuated. And we can see more of the proof from what the company is doing. On one side, we see that Amazon CEO Jeff Bezos sold 3 billion of Amazon stock. And on the other side, we see Alibaba Group upsize the buyback program to $10 billion. So someone can sell his company shares for personal reasons. But I don't think it's likely to happen if he actually thinks the company share is undervalued. And vice versa, a company would not want to buy back their own share if they don't think it's too cheap. Usually, that's what happens. In January, we saw US blacklisted Chinese company smartphone maker Xiaomi. And we saw that Xiaomi's share price really took a big hit because of the political issue. And then in March, we see smartphone maker Xiaomi to buy back shares up to $1.3 billion. It tells me that they think their company's share price had been beaten down because of politics, and it has gotten to be a wrong valuation that is making the price too cheap. So yesterday's video, I compare Yihang with Virgin Galactic because they both share something similar, which is the fact that they don't have the product commercialized yet. And the share price had been hyped up in the past and pricing in the future. It has also run up quite strong and came down quite hard, rebound and come down even further. Just like Yihang. Here we see that the CEO of Virgin Galactic, Richard Branson, sells over 150 million in Virgin Galactic stock. It was April 14 and he sold his share in the past 3 days. So it should be somewhere around here when the share price was about 28 to 30. This tells me that even though after a big fall like this, he might still think his company is not cheap. On the other hand, I see that Yihang has been blown up to 100 something and the management did not sell the shares. Look at LKCO. The share price had been on the floor for a long period of time and suddenly it jumped up to $3.8. Did the insider or management sell a single share? Nope, they did not sell anything. It means even after the share price had gone up 500 to 600% in a short time, they still think their company is undervalued and should be worth much more. So yeah, have the Chinese stocks been falling harder? Yes, they did. Does that mean it's not right to buy Chinese stocks right now? Not for me personally, but you're free to do what you want and what you believe in. For me, I don't believe in what I see from the share price. I believe in what I see the institutions are doing and what the company is doing. Of course, because the share price just keep dropping every day, almost, and it would make people feel anxious and start to have a lot of doubts and questions. But this is exactly why I make plans before things happen. And I made it in last December, before this roller coaster, with my full analysis. So if I have to compare the plan I made before when I was calm and what I feel I want to do based on my emotion, then I would really prefer to choose the plan I made that was not affected by the current price action. Because I know that we are all human and we all have emotion. And this is what the stock market is good at. It is good at making you feel desperate. It's good at making you change your mind. It will find a way to torture you, to challenge your patience, to make you doubt your decision. The stock market is great and evil. It's very good at doing that. So I put more doubt on what I feel right now and believe more in what I planned before all of this happened. Especially when I see all the institutions' action and research had confirmed my belief even further. Next question is, why do they just keep falling? Well, first of all, what goes up fast must at some point drop hard. Like the cycle I just described, it always begins with fear and ends with greed. For a lot of Chinese stocks, I did get in when there was full of fears. But what I did not expect was how fast the fear had grown into greed. that at some point many people were getting greedy on Chinese stocks because it grew much more than the other ones. So it turned out that it really didn't take long from fear to greed, and that was one cycle. And if we need the cycle to begin again, we need fear again. So I think if we want the cycle to start again, we need more and more people to start to think that Chinese stocks just have no future and they need to stay away from it because it's too risky. It is not until more people feel fearful about Chinese stocks again, then they would rise again. Meanwhile, the capital is doing another cycle in another sector. The report from JP Morgan also shows the global equity performance by region, pre-vaccine and post-vaccine. We can look at this chart that's post-vaccine since the end of 2020 to now. And the red line is Chinese, while the light blue is US. So basically, they think that China was controlling COVID well last year, and now US and the rest of the world would recover well from the vaccine. And the market has been pricing in this, and that's why the stock performed like this. So I think this fall was mainly because of the political news at the end of last year and beginning of this year. And after this fall was pricing in the economy reopening and recovery from the rest of the world. So you remember this Gartner hype cycle I showed you yesterday in my EH video? This is for a new technology to happen, and it first begins with a hype cycle before it can slowly realize. And that's why we would first see a huge jump of stock price first to price in a lot of the future, come back down hard and slowly climb back up again when it starts to realize. I know this is for new technology, but I think this is what's happening right now for the recovery as well. Right now, for recovery, I think we can look at it just like new technology because COVID had never happened like this before. The world had never needed to recover like this before. That everyone is expecting a giant boom in the economy and explosion at once for all the recovery industries. So right now the capital is hyping up this cycle like it's a new technology. That's why we can see some recovery stocks being hyped up even before things happen, before the reopening, when the revenue is not showing anywhere near the performance of the share price. Like for example, if you look at a casino stock that I owned before, this is called Century Casino. I bought this in April when it was 2.5, and look at how much it has been growing. So I've sold it at 6 to 7 because I thought it's already at the level of pre-COVID. So basically before the pandemic, with the normal revenue, that's how much it's worth. But no, it just kept going, even though right now the revenue is nowhere near pre-COVID level. And we have no idea how fast the recovery would be, but it can just keep going. So I see this just like the Gartner hype cycle. Of course, they're gonna hype up this because it has never happened before. Capital finds all kinds of opportunity to hype up anything, and this seems to be another golden opportunity. Because when it has never happened before, it's full of imagination, and it would only stop when most people are greedy and switch from tech stocks to recovery. So this is why I think the fall of Chinese stocks is driven by the big hit of growth stocks recently, the constant political news of the delisting issue, and now the market hyping up the economy recovery, post-vaccine news. And finally, what am I going to do? So first of all, I said that I would focus on the companies I have the strong conviction on, even if it means I have to cut loss on some of the other investments, because at least I can be less stressed. So if I need to be a bag holder, at least it's for the companies that I believe in the most and I have confidence they would grow back. So I'm not losing my sleep over my investment, because I don't think anything is worth losing your health over on any kind of investment. Second of all, be very clear between the long-term and short-term investment. For the long-term ones, stick with the high conviction ones and just forget about the price movement. So whenever the price drop, you don't ask yourself the question every day, is this company still good to invest? And for the short-term one, stick with the stop loss. Remember I showed you this example of real estate before? When there's a housing crash, the money would go pick up the hot deals at the city center, the downtown area first. That would be the FANG stock. And then the next would be the midtown, the popular area, like the medium caps, the popular hot stocks. And right now for the Chinese stocks, the FANG stocks like Baba, Tencent, BIDU, and JD.com, this kind of FANG stock had dropped to a level that's looking better on the valuation. So then it's not a bad idea to add more of the FANG stock of Chinese and add more of these kind of FANG stocks. It has dropped quite a bit, especially Alibaba is still quite undervalued, and now that the government's case is near the end, making the valuation more attractive. And Baidu, that has gone down from the high of 354 to the low of 176, so it's cut exactly half. As a tech giant of China, if Google dropped 50%, wouldn't you think it's a good deal? No, I think the money would go towards the tech giant that's looking like a good deal first. Like Xiaomi, even the company is buying back their own share because they think it's too cheap now. So a lot of the tech giants have gone down to be looking like a good deal, and I think the capital would first flow into these FANG stocks of China first, and then later on the medium caps like NIO, for example. It's gone down to a good deal for a lot of investors, even though it might still be under some temporary attack. And also TAL, it is also one of the victims from the margin call of Bill Huang. And it's a medium cap, it's a good company. The small caps might take longer to recover because they are more risky and there are so many good deals in the market right now for the larger and medium caps. For my 5 favorite stocks, NIO is the only one that has high valuation. Recently, with the big drop, it has gone down to a much more attractive return on investment level. And I still think a lot of people don't understand the real potential, the business model. So a lot of things have not been priced in for the valuation yet. EH, I said that this is the stock to buy for the grandchildren. With the recent drop, it's become a much smaller position in my portfolio. So if this company succeeds, it would be at least 10x, if not 20. If it doesn't, I don't lose much. So in this price, I think the risk-reward ratio is quite high. Luckin Coffee. If there is any company the Chinese government right now wants to succeed the most, it might be Luckin Coffee. Just for the reason that no one can use. This is the next Luckin Coffee to short any of the Chinese stocks anymore. And both Luckin Coffee and Zep are currently holding cash that's half of their market cap. So I'm not worried about their valuation at all. And the potential is still there. Among these, LKCO might be the most risky one because it based a lot on the hearing coming up in a few weeks. And I have stressed it many times, invest in what you can afford to lose. But if this company succeeds, it would be a quite high return on investment as well. Right now, the only thing is smaller cap might take more time. So it doesn't hurt to diversify to the bigger and medium cap when there are good deals everywhere. Especially we know that the capital is endorsing a lot of recovery and value stocks now. So I also recommended a few stocks that might benefit from the recovery, and also talked about a hedge against political issue to be cybersecurity like FEYE and CRWD, CrowdStrike. They are in the same sector. Or if you want military, like weapons, like for example LMT, RTX. Now I hope this video can answer some of your questions about Chinese stocks and have given you more information to help you plan your portfolio. And if you have enjoyed this video, please give me a big like and write me a great comment, and I will see you in my next video. That's it guys, hope you can find my videos helpful. Make sure you subscribe to my channel and give me a big like. Thank you.